Right now, as you read this, your bank balance is showing a number. That number feels real. It feels like yours. It feels safe. But here's what nobody's telling you. That number is a story. Not cash in a vault, not gold in a safe, not even a promise anyone intends to keep. It's an entry on a digital ledger inside a system built on lies that made a handful of people billions while putting everyone else at risk. The American banking system wasn't designed to protect you. It was designed to extract from you. And every time the system broke, every time people lost everything, the architects didn't fix the problem. They sold you a new lie and made themselves richer. In this video, I'm going to show you the billion-dollar lies that built American banking. Not theory, not opinion. The actual historical record of how powerful men created crises, blamed you for panicking, then redesigned the system to give themselves more control and more profit. I'll show you the pattern that repeats across 150 years of banking history. I'll show you who got rich every single time, and I'll show you how these same lies are operating in your life right now, every time you deposit a paycheck, take out a loan, or trust that your savings are safe. Because here's the truth. The people who built this system knew exactly what they were doing. They understood that most people would never look under the hood. They understood that complexity creates cover. They understood that if you call theft liquidity and fraud fractional reserve, people will accept it as normal. And they were right. Let me start with the core illusion. The thing almost everyone believes but almost nobody questions. Ask 100 people where their money is, and 99 will say the same thing. In the bank. They believe the bank holds their money, that when they deposit their paycheck, those dollars sit somewhere with their name on them. That banking is boring, stable, and fundamentally honest, that regulators watch everything, that insurance makes it all safe. This is the foundational myth of the American financial system, and it's completely false. Here's the reality. Banks are highly leveraged profit machines. The money you deposit doesn't sit in a vault. The bank immediately lends most of it to someone else. They take your $1,000 deposit and lend out $900. Then that $900 gets deposited somewhere and $810 of it gets lent out again. Your $1,000 becomes $2,110 of money in the system through the magic of fractional reserve banking. This isn't a side feature. This is the business model. And here's what that means. If you and everyone else who believes my money is in the bank tried to withdraw it at the same time, the system would collapse in hours. Not days. Hours. Because the money isn't there. It never was. But the marketing says your money is safe and available anytime. The website shows your balance like it's sitting there waiting for you. The ATM gives you cash on demand. Every signal tells you the money is yours and it's safe. That's lie number one. And it's not a technicality. It's not a boring detail about how banking works. It's a foundational deception that makes the entire system possible. Let me show you where this lie came from. Lie number one. Your money is in the bank. In the 1800s, American banking was chaos. Anyone could start a bank, print their own notes, lend aggressively, and when things went wrong, they'd fold, run, or blame market conditions. These were called wildcat banks, and they collapsed constantly. People lost everything. But here's what's important. The problem wasn't that banks were unregulated. The problem was that banks were lying about what they had. A bank would print $10 in notes for every $1 in gold they actually held. Sometimes $20 in notes. Sometimes $50. When people figured this out and tried to redeem their notes for gold, the bank would collapse. Depositors would lose everything. And the response wasn't, stop lying to depositors. The response was, we need better banks run by better people. This pattern is critical. Every time banks over-leveraged and collapsed, the solution was never transparency or smaller leverage ratios. The solution was always more centralization, more complexity, more professional management. Why? Because the people designing the solutions were the people profiting from the lies. By the early 1900s, fractional reserve banking was standard practice. Banks kept roughly 10% of deposits in reserve and lent out the rest. This was presented as sophisticated financial engineering, as efficient use of capital, as the foundation of a growing economy. But here's what it actually was: a legalized promise that couldn't be kept. Every bank in America was telling depositors, your money is here and safe, while simultaneously betting that depositors would never all ask for it at once. And when they did ask, when confidence cracked and people lined up to withdraw their money, the banks didn't have it. They never had it. The money was lent out, tied up in long-term loans, invested in illiquid assets. This brings us to lie number 2. Lie number 2. Bank runs are random accidents. The official story of bank runs is that they're psychological events, irrational panics, mass hysteria that destroys otherwise healthy banks. This is a lie. Bank runs are not random. They're the logical outcome of lie number 1. If you promise people you have their money when you actually don't, eventually someone's going to check. And when they check and you can't deliver, everyone else is going to check too. That's not hysteria. That's rational behavior. But here's how the lie works. By framing bank runs as psychological rather than structural, the people running the system can avoid taking responsibility. They can say the bank was fine until people panicked. They can blame depositors for being irrational instead of blaming banks for lying. And then they can use the crisis to centralize more power. Look at the pattern between 1873 and 1907. Multiple banking panics. Each one followed the same script. Banks overleveraged. Something triggered withdrawals. Banks couldn't meet redemptions. Panic spread. The economy collapsed. And after each panic, the response was the same. We need a stronger system. We need central coordination. We need professional oversight. Never. We need banks to stop lying about having money they don't have. The Panic of 1907 was the final act in this play. Banks failed. The economy seized up, and a handful of powerful bankers, led by J.P. Morgan, stepped in to save the system with their own money. This was sold as proof that we needed those men, that we needed their wisdom and their capital to prevent future disasters. But here's what actually happened. Those men created the conditions for the panic through overlending and speculation. Then they used the panic to justify building an institution that would centralize their power permanently. That institution was the Federal Reserve. Lie number 3. The Federal Reserve was built to protect you. In 1910, a group of the most powerful bankers in America took a secret train to Jekyll Island, Georgia. They met for 9 days, and they drafted the blueprint for the Federal Reserve System. The official story is that the Fed was created to prevent panics, stabilize the currency, and protect the public from the chaos of unregulated banking. Here's the reality. The Federal Reserve was designed by private bankers to give themselves control of the nation's money supply, while using the government's credibility to back their decisions. Look at how it was sold to Congress and the public. Never again will we have banking panics. Never again will ordinary people lose their savings to Wall Street speculation. This is a government institution that will finally bring stability. But look at how it actually works. The Federal Reserve is technically a private institution. Its regional banks are owned by member banks. Its leadership comes from Wall Street, and its primary function is to manage credit and liquidity for the banking system. Not for you, for the banks. When there's a crisis, the Fed doesn't ask, how do we protect depositors? It asks, how do we protect the banking system? And those are not the same question. The Fed can create unlimited money. It can set interest rates. It can decide which banks get emergency funding and which banks fail. It's the referee that everyone trusts to be neutral. Except the referee works for one team. This is lie number 3, that the institution claiming to protect the public interest is actually aligned with the largest private banks, that the central bank is independent when its leadership rotates between Wall Street and the Fed like a revolving door. And here's what makes this lie so effective. It's wrapped in complexity. Most people don't understand how the Fed works. They see the official seal, the congressional testimony, the economic jargon, and they assume someone smart is watching out for them. But that assumption is exactly what the system depends on. Now let me show you what happened once the Fed had control. Lie number 4. The dollar is as good as gold. For decades, Americans were told their dollars were backed by gold, not literally convertible for most people after 1933, but backed. The government held gold. The dollar was tied to it. That link was supposed to anchor trust and prevent the government from printing unlimited money. This was the promise. And people built their lives around it. They saved in dollars because dollars were as good as gold. Then the government broke the promise. First, in 1933, FDR made it illegal for Americans to own gold. You had to turn it into the government at $20.67 per ounce. Then, after collecting the gold, They revalued it to $35 per ounce. Instant profit for the government. Instant loss for everyone who had trusted them. But at least there was still international gold backing. Foreign governments could convert dollars to gold. That was supposed to keep the system honest. Then in 1971, Nixon closed the gold window completely. No more convertibility for anyone. The dollar was now purely fiat, backed by nothing except the government's word. And here's the key. This wasn't presented as a betrayal. It was presented as progress, as modern monetary policy, as freeing the economy from the constraints of gold. But what it actually did was remove the last external check on money creation. The Fed could now print unlimited dollars without having to worry about anyone asking for gold in return. The cost of that broken promise didn't fall on the architects. It fell on savers, on wage earners, on anyone who had believed the dollar would hold its value over time. Their purchasing power eroded year after year while the system called it moderate inflation and acted like 2% annual theft was responsible policy. This brings us to lie number 5. Lie number 5. Your deposits are risk-free and guaranteed. After the banking collapses of the Great Depression, the government created deposit insurance, the FDIC. Your deposits up to a certain amount were now guaranteed by the federal government. This was sold as the ultimate protection. Never again will you lose your savings in a bank failure. Your money is safe. And psychologically, it worked. People stopped thinking about bank risk. They stopped asking questions about what their bank was doing with their money. They just looked for the highest interest rate and assumed everything was fine because of the FDIC sticker. But here's what deposit insurance actually did. It created moral hazard on a massive scale. When depositors don't have to worry about bank risk, they don't monitor banks. When banks know depositors aren't monitoring them, they take bigger risks. When banks take bigger risks and fail, the losses don't fall on shareholders or executives. They fall on the insurance fund, which is backed by taxpayers and ultimately by currency debasement. Let me show you how this plays out. A bank makes reckless loans. High risk, high reward. If the bets pay off, executives get massive bonuses. Shareholders get rich. If the bets fail, depositors are protected by insurance, so they don't panic. The bank gets quietly taken over or merged. Executives leave with golden parachutes, and the cost gets spread across the entire system through insurance premiums, or, in a big enough crisis, through bailouts, private profits, socialized losses, every single time. And the lie is that the guarantee is free. That insurance makes everything safe at no cost to you. But you pay for it. Through inflation when the system has to be rescued. Through lower interest rates on your savings because banks don't have to compete for deposits anymore. Through financial instability that gets worse with each cycle because the incentives keep pushing toward more risk. The guarantee didn't make the system safer. It made the system more dangerous while making you feel safer. And that leads directly to lie number 6. Lie number 6. Too big to fail protects the system. By the 1990s and 2000s, banking had consolidated. Mergers, acquisitions, deregulation. A handful of banks controlled most of the financial system, and these banks had figured out the ultimate strategy. Grow so large that your failure would threaten the entire economy. Then use that threat as a shield. This is too big to fail, and it's the most brazen lie in modern finance. Here's how it works in practice. A massive bank takes huge risks. Derivatives, subprime mortgages, overleveraged trading bets. If those bets pay off, the profits go to shareholders and executives. If those bets fail, the bank goes to the government and says, if we collapse, we'll take the whole economy with us. And the government blinks, every time. In 2008, this played out on the largest scale in history. Banks had made catastrophically bad bets on housing. The bets failed, and instead of letting those banks collapse and their executives lose everything, the government stepped in with $700 billion in direct bailouts plus trillions more in Fed programs, guarantees, and asset purchases. The official story was, we had to save the system. But here's the reality. They saved the banks. The system would have survived if those specific institutions had failed. New banks would have formed. Assets would have been bought at real prices. The economy would have corrected. But that would have meant losses for the people who caused the crisis. So instead, those people were protected. And the cost was pushed onto taxpayers, currency holders, and future generations through debt and money printing. Too big to fail isn't a policy to protect the economy. It's a policy to protect specific institutions and specific people from the consequences of their decisions. And here's the moral obscenity of it. Ordinary people are told, live within your means, take responsibility for your decisions. No bailouts for you. But banks are told, if your bets are large enough and reckless enough, the state will save you. Two sets of rules. One for them, one for you. Now let me bring this forward to today. Because the lies haven't stopped. They've just gotten more sophisticated. Modern banking isn't about simple loans anymore. It's about derivatives, securitization, shadow banking, overnight repos, and a dozen other complex instruments that most people have never heard of. And that complexity is intentional. It's not a side effect of financial innovation. It's a feature, because complexity creates cover. When a bank can hide risk inside a synthetic CDO squared or an interest rate swap, regulators can't see it. Investors can't price it. And when it blows up, the bank can say, nobody could have seen this coming. But someone did see it coming. The people structuring those products knew exactly what they were doing. They were taking massive risk, hiding it in complexity and collecting fees and bonuses while the risk was building. Then when it explodes, the rescue comes quietly. Not through visible bailouts that anger the public, through Fed programs with boring names, through liquidity facilities and asset purchase programs and quantitative easing. The public doesn't understand what those things mean, so they don't get angry. They just accept that smart people are managing the system. Meanwhile, the same pattern plays out. Banks take risk, profits go private, losses go public, and the system gets more fragile with every cycle because the incentives never change. Let me make this crystal clear. Here's who wins from these lies. The winners. Large banks and their shareholders who profit from leverage, fees, and government protection. Every crisis makes them richer and more concentrated. Executives whose compensation is tied to short-term growth and who leave with millions before the consequences hit. Politicians who use easy credit and money printing to fund promises without visible taxation, keeping voters happy until the bill comes due later. Asset owners whose real estate and stocks inflate because of cheap money and Fed intervention. The losers, savers whose interest rates never compensate for inflation or risk, watching their purchasing power erode year after year. Wage earners whose salaries lag behind asset inflation, making housing, education, and retirement unaffordable. Small banks and small businesses that can't access Fed facilities and bailouts on the same terms as the giants. Future generations who inherit a more fragile system, more debt, and more captured institutions. You want to know what this looks like in your life? Let me show you. Every 2 weeks, your paycheck hits your bank account. You see the number, you think, that's my money. But the moment it hits that account, it's not your money anymore. It's an unsecured loan to the bank. They can lend it out, invest it, use it however they want. You've become a creditor to an institution that's leveraged 10 to 1 or more. When you take out a mortgage, the interest rate isn't set by you and your bank through negotiation. It's set by a central bank that just printed trillions of dollars without asking you. That printing drove asset prices higher, making the house more expensive, forcing you to borrow more. When you open a free checking account, you're paying with overdraft fees, monthly charges if your balance dips, and your transaction data being sold. Nothing is free. You're the product. When you save for retirement in a 401k, you're betting that the system won't devalue the currency faster than your stocks appreciate. You're trusting that the next crisis won't wipe out half the value right when you need it. And you have no control over any of it, because the system was built to extract value from you while telling you it's protecting you. Here's what you need to understand. You can't fix this system. It's too big, too entrenched, too profitable for the people running it, but you can refuse to be the easiest victim. First, understand that a bank deposit is an unsecured loan to a leveraged institution. Act accordingly. Don't keep more in banks than you need for near-term expenses. Treat cash as a working balance, not a long-term store of value. Second, diversify where your wealth lives. Don't rely on a single institution or a single promise. The system depends on you trusting one narrative. Break that dependence. Third, hold some value outside the banking system entirely. I'm not giving financial advice, but understand this. The lies I've shown you are all internal to the banking and monetary system. What exists outside that system can't be seized, inflated away, or restructured by people you've never met. Fourth, Reduce your leverage. When the system is built on lies and leverage, individuals with low debt survive crises better. You can't print money when your job disappears or your investment collapses. So don't put yourself in a position where you need to. Fifth, educate yourself. Read the original sources. The Federal Reserve Act, the meeting minutes, the crisis reports. The people running this system count on you not understanding it. Prove them wrong. Let me be clear about what this is. Legalized, institutionalized deception. A system that has normalized transferring risk from people who create it to people who never agreed to it. The problem isn't that banks make profits. The problem is that those profits are built on lies and hidden guarantees that you pay for through inflation, bailouts, and lost purchasing power. You're told the bank is the safest place for your money. You're told regulators are protecting you. You're told the system is stronger than ever. All of those statements are lies. And the people telling you those lies know they're lying. So here's your choice. You can accept the story they're selling you. You can trust that this time is different, that the system has learned that your deposits are truly safe. Or you can look at 150 years of history and see the pattern, see the lies, see who profits every time, and adjust your behavior accordingly. The system will keep running these plays until it can't anymore. The only question is whether you'll be prepared when it happens. If this video changed how you see your bank account, share it. Share it with anyone who thinks the bank is the safest place for my money, because that belief is exactly what the system depends on, and breaking that belief is the first step to protecting yourself. The billion-dollar lies that built American banking are still operating today, still extracting, still transferring wealth upward while promising stability. The choice is yours.